For more on China's stock market, we're joined by Saruhan Hatipolo. He's the CEO of Business Environment Risk Intelligence. Always good to have you on the show. Thanks again for joining us.
Sure.
So, Saruhan, we saw the markets drop by 6% today, the Shanghai Composite, a lot of volatility returning. Is this in reaction to Friday's statement that China's regulators said it would allow market forces to play a bigger role in determining stock prices? Is that what triggered the sell-off, and why the delay?
I would say 100%. The delay was because the market was still weighing options, whether the government actually would be involved in the stock market. But Michelle, that statement, when that came on Friday, I talked to some clients and they were extremely worried. Why? Because they weren't confident that the market actually was in stable trajectory and that they still needed government help. But when China Securities Finance Corporation announced that it would not be involved daily with the market, then they said, well, things are actually going to get worse.
Saruhan, let's take a look at the statement. Let's see what they said on Friday in Beijing. China's Security Regulatory Commission said, and I quote, "With market fluctuations gradually shifting to normal from wild and abnormal, we should let the market exercise its function of self-adjustment." So what does that mean? Is the government saying it plans to stop actively supporting the market?
I think the government was saying, look, we are trying to gauge what's happening here. The market will need to determine whether this is actually right or wrong, right? But the government is saying we are not going to be here all the time. Then there's a rumor that, that 4,500 level, as the stock market reaches that level, the government actually is going to curtail involvement. Every time it reaches there, there's a sell-off because investors are not confident in the market and they know that when it hits 4,500, the government is going to back off and there's going to be more sell-off. So to make a long story short, investors are not confident in the market. We're going to see more pain in the next couple of weeks.
Well, let's look at the measures that the government implemented in order to stop that massive rout we saw in July. The Chinese government implemented a wide array. IPOs were suspended, rules on margin lending were relaxed, restrictions on selling stocks, on short selling were imposed. There was a fund to buy government-backed funds to buy billions of dollars worth of stock. And investors that hold more than 5% of a company were restricted from selling.
Right.
Where do we stand with those restrictions? I mean, most of them are still implemented, right?
They are still implemented, but the difference is, Michelle, there's still uncertainty in the market and there's some lack of transparency that investors are very concerned about. And what is that? Again, the 4,500 level is very important. When the stock market goes there, there's sell-off. There's also uncertainty in terms of, or lack of transparency, I should say, in terms of how much the government has spent. We don't know that. There's estimates. Goldman Sachs, I think, came out with $140 billion was spent already. So the market is on edge still.
What do you make of the timing of the statement with all the volatility that's been going on, with the devaluation of the renminbi, with all of the mixed data that we've been getting? Why say this on Friday? Why now?
Well, because there's market liberalization measures that need to take place. So the government has to convey that message eventually to the investors that, look, this is the stock market. There's going to be fluctuations and you need to get used to this. But again, because of that lack of confidence, we're going to see much more fluctuations and we may see more intervention from the government. I'm not ruling that out yet.
So you're saying they're saying they won't intervene as a way of like preparing investors for the future of less intervention? More like how the Fed in the US says, we're going to raise rates, we're going to raise rates, we're going to raise rates, just to sort of psychologically get people used to the idea?
Correct. With one difference though, Michelle, with Federal Reserve, for example, if we look at the quantitative easing bond buying program, we knew how much or how many bonds would be purchased per month and when the bond purchasing program would end. So investors got that, and then they read into when the interest rate increase is going to take place.
Right.
We don't unfortunately have that in China yet, and there's a lot of uncertainty because of that.
A lot of uncertainty with the renminbi as well, and the devaluation that's been happening there. How has that impacted the markets?
Well, very badly, of course. But again, we saw the signs of the devaluation about a month and a half, 2 months ago, because the government was talking about this. And then the data came with exports in July contracting by the largest magnitude probably in a certain long time period. Manufacturing data,
yeah.
Exactly. Manufacturing data was really bad. So the and then let's not forget that China is trying to shift from investment-driven to consumption-based economy. So all of these things are meeting, coming at a very bad time period, but devaluation has not surprised us, has not surprised our clients as much as we've seen in the market.
But some sectors in the Chinese economy and the companies linked to those sectors should benefit from this, like the exporters, for example.
Sure.
Who do you, which companies or which sectors do you think can expect a stock increase, or do you think that the overall volatility in the market is going to drag down those companies, even though there could be strong fundamental support for them?
Unfortunately, I agree with you. There's manufacturing is going to be positively affected by that, but then because there's so much value loss, we're talking about $3 trillion, which is 1/3 of the GDP. That's huge paper losses right there. So overall, the economy is not going to benefit immediately. And again, Michelle, if we look at emerging markets nowadays in the past 3 months or so, the devaluation or depreciation of their currencies and look at their export performance, that's not actually helping their exports because global demand is also very weak. So we're going to watch very carefully what will happen in the next couple of months.
So very quickly, Sarahan, you see the market volatility continuing, but to the downside?
Unfortunately, we should be ready for more pain.
Okay, thank you so much, Sarahan Hatipulu, CEO of Business Environment Risk Intelligence.